I'm sure you guys have all heard that lump summing your investment, aka putting your money into the stock market in one go versus DCAing in, is better than any other strategy and will help you beat the market out consistently and has better returns in the long run. I'm here to break down that strategy, provide my thoughts, and tell you why I don't think that is the best strategy with some data to back it up, and why I think DCAing, aka dollar cost averaging, is the best investment strategy for the average retail investor, with plenty of reasoning to support that claim as well. So again, if you're a new investor and you're unfamiliar with some of the terms here, lump summing your investment means you're basically just throwing it all into the market at once, or whichever portion you're comfortable with investing, you throw that all in at once. DCAing in is dollar cost averaging, aka you are averaging your investments over time. So if you have $1,000 to put into the stock market, you would have an investment time period of 12 months. So you'd put, a little bit less than $100 in per month in a scheduled amount of time. You could do that on a monthly schedule. You could do it on a weekly schedule, on a daily schedule. It just means instead of putting all of your money in at once, you put small portions of your money in at once to hopefully average out where you're buying in the market. You're buying at the highs, you're buying at the lows, you're buying in the middle. That's kind of the idea behind DCAing. And so now if you look up which is better, lump sum investing versus DCAing, and you will see that it says lump summing investing is statistically proven to be more profitable than dollar cost averaging. I actually have a major problem with this because I really do think it leads the average retail investor down the wrong road. You look this up and you'll see every financial website from Investopedia to Morgan Stanley, all these research sites citing that stat. And in reality, the statistical advantage that they're citing is actually quite small. It's about 0.42% better than DCAing or other strategies over a 12-month basis. So cool, you beat me by half a percentage point. But what these people don't account for in that research is that market timing is paired with retail psychology. Okay, so to start on attacking lump sum investing, what is market timing paired with retail psychology? With a quick Google search, you can search retail investors and market timing. And you can see here, market timing and retail investors. Market timing is an investment strategy where investors attempt to predict future market movements, aka buying low and selling high, to generate returns superior to a passive buy and hold approach. While this strategy appeals to many retail investors, research consistently demonstrates that successfully timing the market is extremely difficult and often detrimental to long-term returns. It has a couple of different sources here that it cites, but in other words, what this is summing up is that retail investors, aka you and me, are the small fish in a big pond, and pretty much all market psychology is working against us. You have hedge funds and all these institutional investors that have all these legs up on us. They can see the latest amount of market depth data. They have access to the right information at the right time that's locked behind a paywall, or maybe you just don't have access to it regardless of what you pay. And also, this isn't the average person's full-time job. If you are an engineer, if you are a teacher, if you are a dock worker, substitute any job that you want other than a finance job, you don't have the full time to dedicate yourself to understand the financial markets, let alone the intricacies of trading and investing. It's one thing to understand basic economics, but stock picking is a whole different game. You have RIAs and financial advising firms that also don't like to stock pick because it's nearly impossible. It's a fool's game if you don't really have 100% of your time able to be dedicated towards that game. So when you pair the fact that you are automatically at a disadvantage because of lack of time and access to data, you pair that with the fact that you have predatory hedge funds that know that they have a leg up on you and are using that against you and working your psychology against you when the price goes down or price goes up and moves in certain different ways. They know how that is going to trigger your actions just based off of past data. Most people work the same way in the market. So ultimately, they're able to manipulate the price. You hear of market manipulation and whales manipulating. They're ultimately able to manipulate your psychology and make you think that the market is moving in one direction or another. And that's where lump summing gets pretty tricky. So even though, yes, technically putting all of your money into the stock market near the cycle bottom. So yes, it is true. Putting all of your money into the stock market near market cycle bottoms will get you incredible returns. Buy low and sell high again. Super easy. That's easier said than done. What happens in a situation like this? Let's look at the SPY chart between 2008 and 2012. Okay, so I hope you guys can see this all right. So we're looking at the SPY chart between 2008 and 2012. Now, I know this is a huge example to get into because it's the global financial crisis, but this goes to show that the average retail investor probably got screwed out of their money because they're used to markets going up and going down within certain percentage points. And you have, 10% up, 10% down within a couple year periods. That's pretty normal. So when you have somebody where in the market's at about 15 to 1600, they see the market, we got 4 or 5 months later, now it's at 20% discount at 1,270. You think, wow, 20% down in just a couple months, that's a pretty great deal. Let alone it fell more than 50 to 60% in the coming year after that. So what I'm getting at here is if you were somebody who's trying to lump sum your money, you say, I have $10,000 to invest. I'm going to wait for a little dip to try and time the market. 20% dip. Wow, that's a great time to buy. January of 2008. I'm getting the stocks for 20% off. Fast forward a year, you're now down over 60% on your investment and you lump summed everything that you had to invest. So now you're shit out of luck. You have no money to invest. And this is what gets us into the lost decade, if you haven't heard that term, which is basically when you've put all of your money into the markets at one time because you thought it was a good time to invest. Markets go down so far and they take so long to get back up to that point that you invested in that a decade is gone and you've lost all of that time to be putting money into the market, bringing down your average and effectively setting yourself up with a better, lower price base. So the bottom line of what I'm getting at here is that it's extremely hard to time the market and you ultimately don't know how far down it's going to go. So even professionals get it wrong. People get it wrong, and when you get it wrong, you could seriously screw your life up. I don't understand the risk of just lump summing everything in when you could have a almost foolproof strategy of DCAing and have it return less than 0.5% difference. So instead of doing this, instead of just trying to put it all on black and hope that you're right and hope that you timed the market, again, pros even get that wrong. Weighted DCAing, and meaning you pick your regular DCA amount and you have a timing schedule that you maintain over the long run. But if the market experiences significant dips over time, like it drops 10% in a year, wow, that's a decent amount, 20% in a year. So say it dips a significant amount. That is the time when you up your DCA investment. So if I'm investing in $100 every month, that's what I can afford. And all of a sudden the market is just dipping and every day, every week, every month, it's just red candle after red candle. That's the time to up your DCA. So maybe I'll choose to do $150 or $200 for a couple months. Whatever is feasible for me in times of red candles, especially in the longer term, those are the best buying opportunities. And that is the time when you should be upping your DCA investment. This strategy literally gets rid of all of the hassle and all of the worry, and it will completely avoid the lost decade scenario that I described. With that strategy, if you are consistently putting in money during the highs of the market and the lows of the market, and when we start to get to the lows of the market or what feels like it, you don't even have to be perfect. It could just be, oh, we've been down a couple percentage points in a couple days or a couple weeks. I think I'm just going to up my DCA a couple times. That strategy is foolproof and you will never ever go wrong with that, where there's a lot of room for error in the lump sum investing strategy. So ultimately, to sum this all up, if you are not a professional investor and you don't have 100% of your time dedicated towards being in the market, I highly advise against going with the all-in-one go silver bullet lump sum investing strategy. It is a recipe for disaster, and your psychology will get the better of you if you put all of your money in at the wrong time and you start to see even a little bit of red, let alone a lot of red. I prefer the DCA strategy because it just takes all of the pressure, all of the weight, all of the worry out of your mind. You do not have to constantly check what the markets are doing in the short term, checking your phone every 5, 10, 15, 20 minutes, thinking, oh my God, am I up? Am I down? Is my investment going to crash? Am I going to get liquidated? Because you're not putting it all on black. You're spreading your hand out and you are doing worry-free investing. So again, do your own research. Those are my thoughts on that topic. But if you guys enjoyed today's video, please leave a like and a comment telling me which part you like the most or even which part you might disagree with. This is investing. Everybody has their own different strategies. Everybody has their own different approaches and opinions on things. So let me know what you guys think. Subscribe if you're new here so you can stay up to date on more videos like this in the future. And I'll see you guys in the next one. Peace.